So we're just going to cash settle you out at whatever last night's price was and fondue, and now we won't have a gold market anymore.
Okay, so if that happens, my contention is if that happens, and it will happen, then the dollar loses all purchasing power in a matter of days.
Yeah, maybe.
Hey guys, Rafi here from the Endgame Investor, and today I have a very special guy who's been on my channel once before. He was one of my first guests. This is Craig Hemke of the TF Metals Report, and we're going to discuss something that might be a little bit touchy between different camps in the gold and silver community, because everyone has their theory as to exactly what's going on and what's going to fall first, and what order are the dominoes, and how exactly are they going to fall, and who's going to get to say I was right at the end. But so Craig has a little bit of a different theory. The people that focus on the Comex have one theory, and he believes something slightly different. And I just wanted to try to understand his point of view, and he's got some important points. And in the end, we all have our belief system basically on how these dominoes are going to fall, but it doesn't really matter exactly how they fall. And whoever's right can get a cookie at the end. So, Craig, how are you doing?
Hi, Rafi. I'm a special guy. I like that.
Right.
No, it's good to see you, my friend. You do great work, and you're a great follow on Twitter. You're always putting out good information, whether it's on this channel or through Twitter or whatever. So, hey, anytime I can help out, I'm happy to do it.
Yeah, good. So let's jump right into it. My first question is, I noticed, and I put this out on the Endgame Investor, there was a lot of activity in the spot gold contract. There were thousands of deliveries being made, and on January 11th and January 18th, January 19th, just like these big numbers. And you noted that the contract ended with only 889 in open interest. And just to give the listeners a little bit of background, January is not an active month. There's not a lot of trading in it. And if you buy a contract in January gold now, and it is January, then you're buying it into the delivery window, so you have to be ready to make or take delivery, depending on whether you went long or short. So anyone who trades in this contract is either making or taking delivery, or is prepared for it. So we had our theories as to why there is so much volume in the spot contract now, and some people believe that there's a lot of deliveries being made, physical gold is moving, and there's evidence that it's just a shuffle. Craig, I understand you believe it's a shuffle. So my question is, how do you see this shuffle, and why would banks trade warrants, physical warrants of gold in the spot contract rather than just, trade futures? What are they doing? How is it benefiting them if it is a shuffle?
Yeah, that's ultimately, you'd think there's got to be some kind of profit motive, right, on these trading desks to play around this way. It could also just be you shuffle around some warrants during the delivery month, just to make it look like there's deliveries that are taking place. And you kind of got to go back in time. What's happening here in January 2023 is not like the first time we've seen this stuff. And if we're, where we had 600, I think it was 680 or something contracts open at the end of December when the January contract went off the board. And now we've done like 6,000 deliveries. But you go back prior to 2020, really, when everything changed, early 2020. You go back from when I first started watching in 2010 all the way through 16 and 18 and 19. 6,000 contracts was a lot of deliveries during like April or June or December. And the Comex used to average 6,000, maybe 8,000 total deliveries during a delivery month. Mm-hmm. Now they're doing 20, 30. Back in June of 2020, it was like 55,000. And there was a whole series of events that led up to that change. And we can talk about that today. We can talk about it some other time. But what it used to be is, even during delivery months, and this is before really, there are now so many people that watch this stuff. There used to just be a handful of us. Back then, nobody really paid that close of attention. You'd get 4,000 contracts standing for delivery in April, and they'd do 4,000 alleged deliveries. And then you'd watch the delivery reports on a daily basis, or you'd catch up at the end of the month and you'd see JP Morgan house account was stopping, they stopped 2,000 contracts that month. And the house account of Citi issued 2,000 contracts.
So stop means taking, right? And issue means...
Yeah. Stopping means you're the one that's buying, taking the delivery, and then issuing is the one that's making the deliveries. And then you'd turn around 2 months later in June, and it would just flip. And these warrants would flow back the other way. No metal had never ever left the Comex, and nothing. You couldn't like track the daily vault summaries, and say, oh, here, look, I can see the gold actually go from one vault to the next. And so it had the appearance of really just a charade. And why would you conduct a charade? Well, because on the Comex, you're trading these derivatives that don't mean anything. I mean, they're not. I mean, nobody ever stands for delivery. The speculators are buying them on margin, which is cash they don't have. And the banks are issuing the contracts and taking the short side with metal that they don't have to deliver in the first place. So you might as well be trading baseball cards. But that exchange, that price that's discovered through the trading of these derivatives is what's deemed as the basis for the actual spot metal. My friend Ned Naylor Leyland coined the term a dozen years ago, that the futures tail wags the spot dog. And that's why, I mean, you think about that Nowak guy that got convicted from JP Morgan. He ran JP Morgan's precious metals trading desk, but he was also on the board of directors of the LBMA, right? Mm-hmm. So you got, the invisible hand that is managing the price through futures and then delivering metal at that derived price in London. And if you can't match up, if you can play all your games with your derivatives and your futures, but you still got to be able to trade, you got to be delivering metal at that price. And so that was in my mind, and again, I'm dead wrong. What do I know? But that's why they always played these games, so that they would actually, hey, look, there's some delivery being made on Comex at these phony, fraudulent prices that were discovered through the trading of their futures contracts. And it's just these banks and this, here, you take it this month and I'll take it next month, and then we'll create this illusion of delivery.
Okay, so you're saying the advantage of, instead of just trying to make money off of futures, of generating these numbers in the spot contract and taking these warrants, and which is going to cost more money because they can't do it on margin, they have to do it on cash. Right. So you're saying that making this illusion of deliveries in a non-delivery month makes it look more legitimate, and that's how they keep the futures market legitimacy going? Is that
I'm talking, this is how it used to be in delivery months, Rafi. I'm talking like June and August and February in 2015. Right. Okay. And this is how they used to even do it in delivery months. That's where it first caught my eye. Now, what they're doing in January of 2023, because the volumes now are so much larger after what happened in the first quarter of 2020, is maybe an entirely different thing. But what caught my eye all those years ago was this kind of phony baloney theater of just swapping them back and forth every other month to create this charade, this illusion that they're actually delivering metal at the price that's discovered through the trading of their derivatives. Mm-hmm. Now, that all just eventually just blew up. I've alluded to this a couple of times in the first quarter of 2020, where exchanges for physical on a daily basis got to like 30,000 contracts a day, and these banks were either selling the spot, the XAU USD, and then buying the future contract and trying to nip it for a couple of dollars. And the whole thing, it was outrageous. Open interest got to like 800,000 contracts.
Yeah, that was just before March 2020, just before the blow up.
Right. And the whole thing, boom. And remember when it all blew up, all of a sudden the spread blew out like $100 between spot and futures. And all of a sudden, here came the CME group trying to shore up, with, what do they have it? Pledged gold. And then they started that new contract where they said they could deliver Comex obligations with fractional parts of London bars.
Was this coincident with the lockdowns, or was it before, or like during?
It was.
Like there was a whole circus that was going on there. It was totally weird. Like all this gold started flowing into New York, and like 400-ounce, like nothing made any sense.
They had to shore up the exchange. I mean, they kind of opened Pandora's box because there was such a shortage of physical metal suddenly when everything locked down. Remember the stories, Rafi, about planes? They were flying planes of gold all over the planet.
Yeah. Actually, I called the Comex over there because I had a cousin who was working there at the time, and he basically said that story is a cover, and it's not, and it's it's bullshit basically. Maybe he's lying. I don't know.
But what they were playing and but they were playing all these games. I mean, anybody, look, I have to go back and read my own shit from 2.5, 3 years ago. But if you Google EFP, Comex, EFP games and stuff, I was writing about this like crazy and calling about open Pandora's box, because the Comex was never intended to be a physical settlement vehicle. Okay, they started trading gold futures there on January 1st of 1975. Well, 6 years after the dissolution of the London Gold Pool, 3 years after the U.S. closed the gold window, and all this, the gold price is going crazy. And they're like, well, we don't have enough physical gold to base it off a physical price anymore. So we got to invent all this other phony baloney crap and get people to, believe that it's just as good as the real thing. And that's where the futures market came about. It was never intended. You were never supposed to, no one was ever in mass supposed to show up on Comex and buy one contract for 100 ounces and then say, and I'll take my 100 ounces, please.
Yeah, well,
it was just this leveraged trading vehicle.
It's
right.
It's the same story. We're talking about like this crazy 4-dimensional onion of fractional reserve within fractional reserve within fractional reserve. And like, this is the overarching fractional reserve of everything, because gold is the original money and all the little fractional reserves inside of it.
Right.
And we're all looking at different parts of this hypercube, and we haven't been able to communicate with each other and talk about what we're seeing. And it's just like this big monster. But now things are starting to look really strange and coming together. And now we have different people reporting on different aspects of this and seeing different parts of it. And it's starting to come together, but it's still very unclear. It's just very shady. I mean, you were talking about the 800,000 contracts in open interest before any of these lockdowns and the whole world ended, basically as we know it, in 2020. So does that have anything to do with it? And like, what was going on with the gold flowing into New York? I mean, all these things, it's just very strange.
Yes.
And it fits in some way that someone is going to have to dig through the rubble after all this is over and tell this story. But we all have different parts of it.
Right.
That's the best way I can describe what's going on. But
and really at the time, and this is now coming up on 3 years ago, it was an existential threat to that whole kind of fractional derivative, fractional reserve, digital derivative pricing scheme. Because these banks were playing this game for what seemed to be easy profit, to 20 or 30,000 exchanges for physical every day, just arbitraging the difference between the spot price and the futures price. And then nobody wanted to do it anymore. And that's why that premium blew out, because nobody had confidence that if you sold, say you bought or sold one or the other, now you're on the hook to deliver metal. And wait a second, maybe I can't get the metal and someone's actually going to want it. And that's why that whole thing just exploded. So to kind of rebuild some credibility to what they're doing there, all of a sudden they came up with all these new contracts. The amount of gold vaulted went from, it was always around 7 or 8 million ounces. What is it now? Like 30 million or something?
What, 20, 22? Something?
Yeah.
What the hell was that?
They didn't have any choice but to kind of start actually dealing some metal out of there to give it credibility. And so anyway, we've kind of gotten off on a sidetrack, but the point is, so when you look at January and all of a sudden there's 6,000 alleged deliveries, that used to be a really good, like December 5 years ago. And now you're doing this in January. So, which is should be the lightest. January is in the past. I've got the data. I could pull it up, but I don't want to get, pull it up on my computer while we're talking. It used to be like 300 contracts or 150 contracts and nothing, right? Because it wasn't a delivery month. It wasn't a delivery vehicle. It wasn't a delivery exchange. So now all of a sudden they're doing 6,000. Now, you talk about a lot of folks will say when they'll see the open interest show up during a delivery month or non-delivery month, and there's a natural assumption that a lot of people make that it's people jumping the queue is the term. You heard that term a lot. It's like, I'm going to put up full margin and I'm going to get in and I'm going to buy 1,000 ounces for immediate delivery here during this delivery month. And it's always assumed that it's somebody jumping the queue and buying that contract for immediate delivery, but it goes the other way too. It can be usually it's a bank trading desk that is immediately selling gold or silver for that matter to raise cash. And the only way you can really kind of match it up is by following the reports that come out every day. And you got to follow it every single day, because on the CME's website, when they put out those delivery notices, the only time you can see the real granular stuff is on there for 24 hours. And then when they update it, they pull that and it's gone.
You mean the daily reports versus the monthly year to date?
And those, unless you're screenshotting those babies every day, it's like a video loop, like a security camera, it's just constantly getting written over. But if you're watching every day, you might see, and you probably saw the one a couple of days ago, that I just used it yesterday. I think it was from Friday, where all of a sudden, most of the volume that showed up is all in two accounts. Maybe it's Citigroup issuing 1,200 new contracts, and or I'm sorry, most of the volume is in one side versus a handful on the other. I guess is the point I'm trying to make. Think like you'll see again, Citigroup issues 1,200 contracts, and then the stopping is like 7 or 8 different entities on the other side. Okay. Well, that should tell you that the bulk of the order was that issuance, that selling, that 1,200. And then it was bought in the market by 7 or 8 different entities. Or it can be the other way around.
I never thought of that. That's true.
1,500 contracts bought by the house account at JP Morgan. And then there's 8 different entities on the left-hand side issuing or selling. So you got to follow those things every day to try to figure out, because and again, this doesn't happen very much, but that contract continues to trade all the way through the delivery month. But to trade it, you have to put up 100% margin, not the 15% or whatever the current margin requirement is for the contract. And so you can show up and it's got to be somebody with size, and say, I want to immediately buy 1,000 ounces, or 1,000 contracts for
right. And then you'll have like 7 or 8 different sellers on the other side filling that order with their algorithms or whatever.
So that's how. So again, it's very important for people, because I still see it's like the Comex is going to default thing, and I know you want to talk about that before I blabber on too much. But I still see people out there say this: every time you see open interest go up during a delivery period, it's assumed that it's just somebody buying, and that's not true. I mean, it could just as easily be an entity selling right away, trying to raise some cash for whatever reason, maybe just to buy it back. Who knows? And the only way you'll know is if you track it every single day, which is kind of a cumbersome thing to do.
Okay, so that is interesting. It helps me frame things in a way that I haven't framed it before. So the other 2 questions I have, and we have about 10 minutes left, is first of all, people say the Comex is going to default, and you haven't like ridiculed that, but kind of like downplayed it a little bit. And I can't disagree with that. So my response to that would be, look, it could be that the Comex defaulting will happen somewhere down the line. It might not be the first domino, but the way I see it, I don't know exactly what the weakest link in the chain is. But once we start to see the treasury market really start to seize up, everyone's going to go after gold, whether mechanically for some mechanical reason they don't even understand, or because they're just psychologically they're going crazy and they need something. It could be both reasons. So I see, like, I kind of see everything cracking at the same time. And, immediately when one link in the chain breaks, the Comex is going to break too. It's not like the Comex is going to survive this. I don't think so. So, whatever comes first, it's kind of a moot point, I think. And the second thing that I wanted to talk about, that I wanted to ask you about, was I saw 18.4 million ounces of silver flow into the SLV ETF. And this is specifically after I saw on Wall Street Silver on the Reddit, and they're talking about like all these mainstream media articles and CNBC and all these other garbage outlets about, silver's going to go up this year. And then all of a sudden, then we see 18.4 million ounces of silver go into the ETF, like after a dump that happened yesterday. Like, what the hell? This is all weird. If you have any comments on that, go for it. I think we have about 9 or 10 minutes.
All right, let's do the first one first, and then stop me, and we'll do the SLV thing.
All right.
Okay. Cool. Regarding Comex default, again, I'm going to go back again to my 12 some odd years of doing this. I mean, this was the big story back in 2010. You know, we're going to, old Max Kaiser's deal, you know, we're going to break JP Morgan, right? During the Comex, bankrupt JP Morgan, all that kind of, and there was some real legitimacy to that story. And that's all ancient history. It could happen on Comex. It has happened before, and that might be something for people to research. Look up the Maine potato contract. How's that? From like 1975. There's an American guy by the name of J.R. Simplot, who's a big Idaho potato grower. And he got kind of wrong-footed, kind of a little bit like the dude in nickel, you know, the Chinese dude in nickel back in March.
Yeah.
Right. And nickel,
50 cents.
All the canceled trades and all that crap.
Yeah.
Well, anyway, this Simplot character was supplying potatoes, a big, massive potato conglomerate, basically in Idaho, supplying to McDonald's, all this stuff. He got wrong-sided in the Maine potato futures. The market blew up. Force majeure. They had to cash settle everybody. It was big news in the paper for like 48 hours.
Mm-hmm.
And then it just went away. And the market went away. Okay, so it's not like this is unprecedented for something to happen. And that's probably what would happen on Comex too. If it did
but potatoes are potatoes and gold is money.
Right?
It's different.
Right. But it would be something like that. They just would say, sorry, we don't have the gold or the silver or the copper or the palladium. So we're just going to cash settle you out at whatever last night's price was and fondue, you know, and now we won't have a gold market anymore.
Okay. So if that happens, my contention is if that happens, and it will happen, then the dollar loses all purchasing power in a matter of days. Yeah,
maybe. Yeah, okay. But it could also, with the power of the media, Rafi, it could just be explained away. Well, you know, these things happen and these banks got wrong-footed and the Fed cut them a check for $100 billion and they paid everybody off and they're too big to fail, these banks. You know, who knows?
Oh, good. Okay, so I think this is an area I think we have a substantive disagreement academically. So I hold that when that happens, when they do cash settle, the dollar will be dead within a matter of weeks at most. You hold that, okay, maybe the media can explain it away. They can, but like, you know, hyperinflation being a psychological phenomenon, I think that's more of like a front end thing. Yeah. A hyperinflation and psychological phenomenon is like what you see on the surface, but like what's going on in the back end is like what's happening on the Fed's balance sheet, what's happening in the bond market. And I think the gold futures market is connected to this in a mechanistic way that the psychology of the public doesn't quite get, but it is connected to through a series of derivative chains. I can't really explain it better than that.
You may very well be right, Rafi. It'd be fine with me if you're right. I'm just saying that that's one way that they could try to contain the damage. The other part of this is it could emanate from another market, because all these other metals, whether they trade on NYMEX or LME or whatever, it's all the same stuff. All this hyper leveraged, rehypothecated. Zoltan Posar, in his last thing at the end of last year, said all this rehypothecated metal is an existential threat to the financial system. And so it might start copper. It could start nickel. Have you seen zinc? Wall Street Silver, Jim put out a thing on global zinc, or I think inventories yesterday. They used to be 300,000 metric tons. It's down to 20,000. Okay. So the whole thing could unwind from one of these other markets where it's like, well, wait a second. If I can't get any palladium based on this, well, I better get my gold because it's all the same way. You know, whatever starts the ball rolling. I guess I think the highest probability is it's a bank run that starts someplace else. You know, one of these Swiss banks that runs a gold certificate program. They said, oh, yeah, we got your gold here. Yeah.
Hopefully anytime one of them in Davos. Let's have
or Davos, you know, in Zurich and Geneva. You know, or some of these mints that run the same kind of unallocated thing where they, you know, sign here and we'll get it to you in 60 days. No. I want it now. Well, we can't get it now. And, you know, all of a sudden it's just the final thread that just unravels the whole sweater.
Right.
And then that bleeds over, you know, the Comex being part of that pricing scheme that bleeds over. It's just going to come from someplace. But in the end, it's the same physical root cause. It's a physical demand of this metal that doesn't exist. The 100 beneficial owners of the same ounce, that kind of stuff.
Right.
And so I don't know where it's going to come from, whether it emanates in a Comex futures contract or a bank in Switzerland. But eventually, the scheme just unravels.
Right. Just to put what you're saying in more in a, I guess, a layman's understanding. Like, okay, so a demand for metal, a physical demand for metal, you could just rephrase that as the demand for money. And if you take it a step back, like in 2008, when there's a severe demand for dollars, right? Everyone's selling their stocks, selling their real estate, selling whatever assets they have because they want dollars. That's in their mind, it's a demand for money, but it's really a demand for a money substitute. That's one layer of the derivative onion collapsing, like we saw in 2008. So so yeah, okay, good. We have 10 minutes left. That was more time than I thought.
So that's all right.
Yeah. So what you're talking about is like a demand for metal. That's really what is that really? It's not a demand for metal. It's not like all of a sudden people want shiny coins in their in their vaults because they suddenly love gold or whatever. It's that they lose faith in the dollar. It's a run of, it's a dumping of dollars in exchange for actual money because people are terrified. That's what they want. And that's what's going to happen. So yeah, exactly which thread, where is the loose thread that's going to pull this thread? I don't know. And okay, maybe it's in Switzerland, maybe it's in the Comex, maybe it's not. So
doesn't really matter.
Yeah,
it'd be a bigger show right away if it was on Comex, but it doesn't really matter if it is. Again, getting back to something I mentioned earlier, the dissolution of the gold pool in London, which was these 8 nations that banded together to feed physical into the market and then take it back out to try to maintain a market price at $35 an ounce. And then there just was not enough gold left to be able to do it. And there's not enough gold left at all to back all these different currencies. And so they got to create this alchemy and create all these substitute forms of gold that's, it's just the same as gold, whether it's a futures contract, eventually becomes ETFs and unallocated accounts and all this other crapola. And it's a confidence scheme is what it is. Which is really no different from your local bank. You can go put, save $1 million in your local bank, which wouldn't be smart, but just for this example, you got $1 million in your bank account. You can't go walking into your bank on a Tuesday and say, I'd like it all in cash. It's a fractional reserve thing. They've got some money in the vault and they might give you 10,000, but they're not going to give you if enough people show up at the same time wanting their cash, the bank's got a serious problem, right? And that's what all these fake gold digital forms are. It's all a confidence scheme. Okay. If enough people show up or if demand just gets to be enough, that it overwhelms whatever above ground supply, visible supply is, then the thing just, and that's what we're all waiting on. Right? And let me get back to your SLV question. If I phrase it right, suddenly Monday the 23rd, what was it, 18 million ounces or something? Can you give everybody the background again?
18.4 million ounces. And I looked on Gold Charts R Us all the way back to the founding of SLV. And I zoomed in to like 400%, and I drew a little black horizontal line to see which bar of inflows was able to cross it. And the only time that we saw a bigger inflow was during Silver Squeeze.
Okay. Where there's all of a sudden demand for new shares and all that stuff, right? That alleged that there was this demand for new shares, and so somebody had to pump in some silver. And where was it coming from?
We got really close to knocking it down. We got really close.
My suspicion is that's not what's going on here. Okay. This gets back to which entities can actually take silver out of that fund and put it in. Which ain't you and it ain't me. Rafi, right?
It's the same bullion banks that are trading back and forth those warrants.
They call them authorized participants, right? And it's mainly the bullion banks, as we call them.
They have the experts. The experts.
Right. They have the ability to create baskets of shares and either sell and redeem, take metal out, or put metal back in. Andrew McGuire, who I've known for about a decade, first alerted me to this, the way he sees it. And again, who knows if he's right? But he thinks the banks have always used those things as a flywheel. That's why they custody them the bars in London. That the banks, again, which are the authorized participants, are also responsible for flowing out the physical metal through London at whatever this digitally derivative futures price is, right? And sometimes they get wrong-footed, right? They got their forward contracts and their leases that they're mismatched and all this other stuff, and they need metal right now. And so what he always said was that, you know, a bank, who cares who it is, HSBC or JP Morgan, whatever, and they need 100,000 ounces of metal right now for immediate delivery, they take it out of the GLD. They short the GLD and they take it out and they deliver it out. Now they're short the GLD, which anybody can see the massive short position in GLD and SLV all the time. But now they owe metal back. And so at some point they're going to go pay it back, put it back in, right? That fits this deposit that you saw yesterday, I think. I think somebody was probably short 18 million ounces if you just want to make it round off exactly. And what happened yesterday? Well, they put in 18 million now. What else will happen yesterday? Oh, suddenly silver was down 6% from its highs. It went to 24.30 and then went to 22.80 in like 6 hours. All the while, wasn't like the dollar was doing anything crazy. Oh, gold caught a little sympathy selling. It was down maybe $9. Platinum and palladium were never down more than about 0.5%. And here's silver down 4%. So let me posit this theory for you, Rafi. Some big bank with a precious metals trading desk had a plan yesterday to redeposit some obligations back into the SLV. They wanted to get it done in the spot market or whatever. And so they had their trading desk in New York naked sell some futures contracts, smash price. The final capitulation came when they got another 20 cents when they broke the 50-day moving average and ran a bunch of sell stops. That's an old trick. And at that point, price suddenly levitated back higher. Now, it could have had something to do with option expiration too, but if you were in the business yesterday of trying to buy the rest of your 18 million ounces to pay back a short position to the SLV, and you had your trading desk in New York run the price down, and you saved yourself $1, that's $18 million. And then the trading desk covered all those shorts on the way back up and maybe made a little money too. That's a pretty good deal. That's a good day's work, Rafi. Dude, we go right out to the strip joint, get the champagne room, party last night. Now look, that may sound crazy, and maybe it is. Who am I? But that's how I
hold on. Just to make sure I'm understanding this. So they had their buddies short contracts to lower the price so that they could cover their existing short position in SLV, but then who's left with the short position in the futures?
You mean within the SLV?
Yeah. So no, not within the SLV. So you said I'm not sure I understand how this strip club party works, but
you start. You start. So, say you start creating short. You know what the book is. And again, I'll just pick JP Morgan, but I don't even know if it's them anymore. But you know what the book is. You know where the orders are, right? So you can see where the air pockets are in the March future contract.
Right.
And so you just start spoofing in orders, which we now know they do. They've been convicted of doing. And anybody that thinks they've stopped.
Yeah.
How many billions of dollars has
trigger stops at a certain position and then cover when it's down.
So you've layered in a whole bunch of shorts, right? And eventually you get it all the way down where price then collapses through the 50-day down to 22.85. And then you just start buying them back. I mean, you probably could work it out where open interest barely changes and you probably net even. You started some shorts at 24.30 and 24 and 23.50, and then you start buying them back, down here at a lower price. Again, I'm not saying I sat there and watched them do it, but I don't think it's inconceivable to think that you could at least break even when you own the market like that. And then if you acquired your physical metal at 20, below 23 instead of above 24 and paid back your 18 million ounces, through some kind of future delivery obligation to the SLV, you save yourself some money.
Right. So I think this breaks when they put these sell orders out to try to knock down the price. People just keep buying them at higher and higher rates, and it just doesn't work anymore. At some point that's going to happen. So we have about 1 minute left. Craig, where can people find you? I know Sprott Money. Obviously, you should read Sprott Money. TF Metals Report. Anything else you wanna tell people? And if we get cut off, well, have a good day.
Well, this prop money thing is just a little side gig I've done for a couple of years. Eric has a company set up for his daughter, and I help him with some of their audio stuff. But my primary focus is TF Metals Report, and it's an online community. It has been for about a dozen years. And if you want a good, independent, objective source of information, take it or leave it. I'm not trying to say I know it all. God, anybody that knows me would know I don't know it all. But if you'd like some thought-provoking stuff and a great online community, that's what TF Metals Report is. I encourage everybody to check it out.
Good. We'll have a link at the bottom in the description. And thank you very much. I always enjoy talking to you. And it's 12 o'clock where you are. It's 12:40, 7:40 where I am. Have a good afternoon, good evening. And we're not in the Truman Show, so I won't say good night. And
all right, my brother. Hey, keep it real. You do a great job, Rafi. Keep on going, buddy.
Thanks, Craig.